In this video, we're going to be exploring the return on invested capital. If you recall what we said in the previous video, which was primarily dedicated to NPV and IRR. Well, in fact, two videos ago, I did say that there are three investment evaluation or assessment methods and measures that your curriculum wants you to know. Those are NPV, IRR, which we've already covered, and now is the third one, return on investment capital. Now, let me give you a bit of background for this. You see, the problem with IRR and NPV is that they are calculated on a project-by-project basis, and you really need to have good information about project cash flows, cash flow forecasts, cash flow projections to be able to compute them. However, you will only have access to those if you're in the company, within a business. If you're on the outside, like an external analyst is, you don't have access to all that data to compute NPV and IRR. So return on investment capital is, I guess, much easier to compute because you can do it using publicly available data. The formula is as follows. It's after-tax operating profit, which you will either be given or you'll be given the operating profit of the company, and you'll need to multiply that by 1 minus the tax rate, which should also be given to you. And this is related to average invested capital. Now this, what's in the denominator here, I'm not going to solve an example with you because there's an example in your book and it's really simple. You just have to take, the profit for a period, like a year, and relate it to the average of long-term liabilities and average amount of equity that the company was using. So you'll be given beginning of period and end of period figures, or end of one period, end of another period figures, and just compute the average of them. Be sure that when you're presented with liabilities, you only go for the long-term ones, like long-term debt, for example, but you do indeed exclude anything of a short-term nature. So exclude short-term liabilities, e.g. accounts payable, so amounts payable to suppliers, which are typically settled relatively quickly. And anyway, they typically don't come with an explicit sort of interest cost. Any short-term debt should be excluded. I mean, in reality, if short-term debt is a permanent feature, then you do include it, but not in this reading, right? They just want you to exclude short-term debt from your computation of invested capital, and you should be fine. This is a really easy computation. What you have to be ready for as well are theoretical questions on the benefits as well as the drawbacks, the downsides of using this measure. So we're going to start with the benefits. First of all, number one, it can be calculated using publicly available information. So using publicly available data, just by looking at the financial statements. So an external analyst can indeed perform this. Brilliant. Another thing that your book talks about is that it can be decomposed into some sort of sub ratios, and this is a feature which you will not find with NPV or IRR. It would be impossible to decompose them. However, return on investment capital is decomposable, I guess. The original ratio is after-tax operating profit to average of invested capital. So what your book proposes is, let's have after-tax operating profit up here in one fraction, and we're going to multiply it by another fraction where I'm going to have average invested capital in the bottom, in the denominator, and I'm going to have sales over here and sales over there. So as you can see, that sales can nicely be or easily be cancelled out. So what you have effectively is a decomposition of a return on invested capital into two sort of sub-ratios. The first one is simply the after-tax operating profit margin. Okay, I'm not writing after-tax operating because I guess you know that. And the second ratio is something we could describe as capital turnover. Your book also calls it potentially asset turnover, although I wouldn't really say so, because asset turnover is based on assets, not invested capital. So you'd not account for the short-term liability financing here. However, the importance of this decomposition is that now you can analyze why return on operating on invested capital is, for example, growing. Is it due to profit margins going up, or capital turnover going up, or perhaps both those things happening? Or maybe why is a company with a high profit margin not enjoying a good return on invested capital? Maybe because its capital turnover is very slow. So this decomposition helps us analytically sort of figure out what's going on. Now, for some more benefits, let's continue them. This ratio is calculated at the company level. Now, you'll see that later on this will also be a potential downside, but here it's a benefit because you're taking the numbers from the overall financial statements, the profit and loss statement, the balance sheet for average investment capital. It is done at company-wide level. Unlike NPV and IRR, which are always project-specific. Okay. However, if you're an external investor, you cannot, but investors cannot generally invest in individual projects. So if you're an external investor, you can invest in the whole company as such, its shares, for example, or its debt. So you're more interested naturally in something that is calculated at the company level rather than individual projects. But I'll come back to this argument in just a moment when we discuss disadvantages or drawbacks, because it's easily turned into a disadvantage. And this measure, so we're still talking about the advantages, right? The benefits of return on investment capital. It may very instinctively easily be compared to the investor's required rate of return. And your book here talks about comparisons done by the company. So a company kind of should have an idea of what its investors require and can easily compute whether it's delivering a return on investment capital that is sufficient to meet those investor requirements or not. And if not, it should, I guess, analyze its projects, analyze its activities, assets, drop some of the underperforming ones, put some more money into the better performing ones. However, please appreciate that when we talk about invested capital as featuring in the denominator of the ratio, right up here, average invested capital, we include both equity and long-term debt. So when you're comparing the ROIC, the actual return on investment capital that was achieved, with the required rate of return as sort of required by investors, think about investors broadly, investors into your equity and long-term debt. So required rate of return should reflect rate required by sort of both equity and debt investors, they will have different rates of return, and we have to strike a balance between it. We typically, compute things like the weighted average cost of capital, which is a nice way of balancing the rates of return required by the two investor types. Okay, not in this reading, however, don't worry about the technicalities. What about some limitations of this measure? Right, you have to know these as well, and there are less limitations than there were sort of benefits. First of all, it's an accounting measure. So it's based on accounting numbers, and you know how accounting numbers are subject to various smoothing exercises, non-cash expenses appearing like depreciation, for example. It gets skewed by accounting, the accounting approach. It's an accounting measure. It's not a cash flow measure. Cash flow measures are generally preferred in finance because things are more objective, and NPV and IRR are based on cash flows, so they are sort of superior in that respect. Plus, accounting is subject to various creative practices that can distort earnings, distort results. Because it's a measure based on financial statement data, it's going to be backward-looking. With NPV or IRR, this is forward-looking because you're projecting future cash flows, not looking at the past. Here, you are indeed looking at something that's already finished. And because accounting measures, especially profit measures, can be quite volatile from period to period, the measure itself, the return, may also be volatile on a sort of year-to-year basis. And third of these is a measure that's going to be a reflection, or basically the same as here, because I said previously return on invested capital is computed at the company level, and that was a benefit, seeing as investors look at companies as a whole. But that same argument can be turned into a drawback or limitation, because the measure itself is highly aggregated at the company level. The fact that you've got some assets or some projects generating good returns may mask problems with others which are underperforming, so may hide weak, underperforming, let's say, areas. That's it for the limitations. See you in the next video.